You already know that banks offer us a variety of accounts to choose from: savings bank account, fixed deposit account, recurring account, or current bank account. Here we will study about recurring or cumulative deposit account today. Well, the word recurring refers to occur again, periodically, or repeatedly. That means you deposit a certain amount of money every month, that is after a fixed period of time. Or the cumulative word means the total amount of something when it's all added together. So this means that when you deposit the certain amount of money every month, and after a fixed period of time or stated period of time, you will receive all that back added up together along with an interest that you receive on your savings. So what is actually a recurring or cumulative deposit account? Well, an investor deposits a fixed amount every month. So let me take an example that Mr. Sharma being an investor here, well, in this case, anyone can be an investor, me, you, a housewife, a businessman, any one of them. Well, an investor, say we were taking Mr. Sharma, deposits a fixed amount every month. So say he saves rupees 1000 every month. Now he will deposit this rupees 1000 every month for a specified number of months. So let us take an example that he is depositing rupees 1000 with the stated number of months, say 12 months. That means a year. So the number of months being 12 here. And on the expiry of this period, which period am I talking about? This 12 months. So this stated period of time is actually called the maturity period. So after the end of this maturity period, that is 12 months, or in different cases, it will vary. He gets the amount deposited by him. So how much amount is he depositing? Can you tell me from here? Rupees 1000 every month for 12 months. So 12 into 1000, 12,000. So he will receive 12,000 plus he will receive interest due to him. So on this 12,000, he will also get an interest which he will receive together with his deposits after the end of the certain number of months, that is the stated number of months, or after the end of the maturity period. Now this sum will actually be called the maturity amount. So what is this maturity amount? This maturity amount is the total money that is being deposited by him plus the interest he is receiving on these deposits. Now, how is interest calculated on a recurring deposit? We are not depositing all the money at once. Say we are depositing rupees 100 for every month. So 100 in the first month, 100 in the second month, 100 in the third month. So our money is actually increasing. So how is actually interest calculated on such balances? Every month my balance is changing. 100 plus 100, 200. Now again 100 plus this 200, 300. So you can see every month my balance is increasing. How is the bank calculating interest on such a deposit? Well, we will learn that today. Now, suppose John deposits rupees 3,000 every month for say 12 months. 12 months, that is a year. So we'll take a year as 12 months. So here, John deposits rupees 3,000 for 12 months. So in the first month, he will deposit rupees 3,000 for the other 12 months because the bank will keep his 3,000 for the 12 months. He will not be returned back this 3,000 for at least 12 months. So interest will be calculated on this 3,000. Let's calculate the interest. Now interest percent is say 6% in this case. So the interest on rupees 3,000 for 12 months on at the rate of 6% per annum. Calculated. Now 12 months, that is 12 by 12. Now 12 by 12, 1 year. Into 6%, that is 6 by 100. Well, this formula you are familiar with, P into R into T. Now, instead of solving this, let us just keep it like this for a while. Now, similarly, he will deposit rupees 3,000 in the second month as well. Now, the total recurring deposit is for 12 months. So, in the next month, that is the second month, he will deposit again rupees 3,000 for the remaining 11 months because the total recurring deposit is for 12 months. So again, interest will be calculated on this 3,000 for 11 months, again at the same rate %. So 3,000 into 11 by 12 into 6%. Right? Similarly, for the third month, rupees 3,000 he is depositing in the third month for the remaining 10 months. So like this, interest will be calculated till the last month. Like this. See, 3,000 for 10 months. So 3,000 into 10 by 12 into 6 by 100. So 3,000 for 9 months. Similarly, only this number will go on changing. 12, 11, 10 and so on till we get the interest for 1 month. So like this, you can see we have calculated interest for 3,000 for 12 months, 11 months, 10 months and so on till 1 month. Now he will receive this whole interest. So we have to add up all these interests so that we can know how much interest he is earning on his recurring deposit. So what we will do? We will add these up. So we need to add these up. Now it was written vertically first. I have written them horizontally now. So 3,000 into 12 by 12 into 6 by 100 plus 3,000 into 11 by 12 into 6 by 100 and so on till the last month. Right? Now instead of adding each of these terms separately, now instead of calculating these separately and then adding it up, what we can do? We can take out the common ones. So 3,000 in common in every term. So 3,000 into, now I can see that 12, 11, 10, 9 until 1, this forms a series. So I can write it like this. Right? And I can see that 12 is also common in each and every term. What common will you see? See, 6 by 100 is also common in every term. So we have simplified this whole expression like this. Now what about this series? 12 plus 11 plus 10 till 1. Is there a simpler way to calculate this series? Yes, we know n into n plus 1 by 2 defines such series. So what we will do? We will, instead of 12 plus 11 plus 10 so on till 1, we will use this series. Now instead of calculating this, we will use this formula so that we can simplify this. So here n will be 12. So in this case, 12 into 12 plus 1 by 2. Now replacing this with this. See, what are we getting? 3,000 into 12 plus 1 by 2. This we have got instead of this. Into 1 by 12, that was common. Into 6 by 100, that was also common. Now, you can see that we have reached a very simplified expression. Now, if I want to generalize this, now in each and every sum, you cannot write so many terms and then calculate. It will take a lot of time. It will be time consuming. So what we will do, we will generalize a formula for such sums. Look at this. This is actually the generalized formula where SI is equal to P into n plus 1 by 2 into 12 into R by 100. Now how is this and this same? Let us see. See, 3,000 is acting as principal because this is what we are depositing each month. Then 12 was actually the number of months for which we were depositing the principal. So this acts as n into n plus 1 divided by 2 into 1 by 12. So 12 comes here into 6 by 100. So 6 was the R %. So R, that is rate of interest, by 100. So see, because of this, we are getting a generalized formula for calculating the interest on a recurring deposit. So from now on, we will use this formula to find out the interest on any recurring deposit. See, so calculation of maturity amount on recurring deposit when simple interest can be calculated by this formula, where SI is the simple interest, P is the money deposited per month, N is the number of months for which the money has been deposited. In our case, it was 12. And R is the simple interest rate % per annum. Now when we deposit money in our recurring deposit account, after the number of months, that is agreed number of months has ended, for which we have to deposit the money, we get back our money along with the interest. So now you know how to calculate the interest on the recurring deposit. Now how much money will you get back? The money you have deposited plus the interest accumulated on it. So after you have calculated the simple interest, that is the interest on your recurring deposit account, you can also calculate how much money you will get back. So the amount of maturity, that is amount of money you will receive when your recurring deposit had matured, that will be total money deposited by you, that is the money you are depositing every month, into the number of months you are depositing that money, plus the interest that you will receive on your recurring deposit account. So now using these two formulas, you can solve the sums of recurring deposit account. Let us solve such a sum. Now Rohan deposits rupees 100 per month in a recurring deposit account for 6 years. Find the amount payable to him on maturity. So what you have to find out? You have to find out how much money he will receive when the recurring deposit has matured, when the rate of interest is 6% per annum. So you have basically all the information given. So we will use the two formulas and find out the amount payable to Rohan. First of all, let us write these information. P is the money deposited per month, which is rupees 100. Then N is the number of months for which the money is deposited. Here we have been given 6 years. So will I write 6 over here? No, we always have to write the number of months for which the money is deposited, because he is depositing rupees 100 per month. So writing 6 here will give you a wrong answer. What we need to do is convert this 6 into months. So 6 years into months will be what? 6 into 12. 72 months. And R is the interest rate per annum, that is 6%. Right? So now we will substitute these values in our formula. Our formula is this for calculating the interest first, where interest is P into N into N plus 1 by 2 into 12 into R by 100. We already know what is P, N and R. So P is rupees 100, N is 72 months and R is 6. So substitute these in this formula and find out the answer. P is 100 into 72 plus 1 by 2 into 12 into R percent, that is 6 by 100. Right? Now solve this. 100 into 72 into 73 by 2 into 12 into 6 by 100. Now how much will you get when you solve this? So you get rupees 1,314. So this is the interest he will get. Now what we have to calculate? We have to calculate the amount payable to him. So the total amount. Now we know that the amount of maturity will be total money deposited by Rohan plus interest. Now we have already calculated the interest. First of all, now let us calculate total money deposited by him. How much money has he deposited till now? Rupees 100 for 72 months. So total money deposited by Rohan will be what? 72 into 100. That will be rupees 7,200. So now you know 7,200 is the total money deposited by him and interest was 1,314. So what will be the amount of maturity? So the amount of maturity will be rupees 7,200 plus 1,314. Add this up, you get rupees 8,514. So the amount payable to Rohan on maturity will be rupees 8,514. So this is how you calculate sums on recurring deposit accounts.